Okay, good evening. Mr. Innocentes mentioned to me that you want a short lecture review with regards to national income accounting and about how to construct the graphs and the like. Okay, I don't know if this would appear in your screen because if you look at the world development indicators here, for example, I selected for the Philippines and you have here country, the 264 country series, and I've chosen for the Philippines. I said I per capita Atlas method 1996 up to 2020. You can convert it into a chart. Okay, view as a chart. They can construct that for you as a chart, or it can be a table. And there, the table is here. We have 2018, 2016, 2015, okay? And you can convert it as a chart. There, okay? So I hope that answers the question of Mr. Innocentes about how to convert it into a graph or a chart. Okay, but before you actually construct a graph or a chart, you'd have to at least understand whatever it is that you are trying to put a data for. Okay, and that's why here, as requested, I'll be discussing GNP accounting, okay, GNP accounts and the like. Okay. Now, here's the thing about GNP accounts, all right? Um, gross national product and gross national income accounts are the same. They are because they're conceptually different, but they are theoretically always equal. Okay. When one measures the level of economic activity in the entire country, the most widely used method of measurement is the GNP accounting or the GNI accounting. Okay. Now, in theory, from macroeconomics, the aggregate demand is always equal to aggregate supply. Aggregate demand refers to the demand for all goods and services. Aggregate supply refers to the supply of all goods and services, and they're always equal because the total goods being purchased should equal the total goods being produced. Okay, and they're equal especially when the goods are exchanged, when you have a purchase. Okay, so therefore in GNI accounting, there are three main equations, two on the demand side, one on the supply side, and these three are always equal. Okay, so when you look at the website of the Philippine Statistics Authority, okay, you will see their data on gross national product, and then the individual elements are there, including their figures for every year. Okay. So on the demand side, there are two main equations. There's the expenditure equation and there's the income equation. Okay. On the supply side, you have the GVA equation or the gross value added equation. Okay. And these three are always equal. Okay. So when you look for the gross national product using total expenditures or the spending, okay, it's equal to consumption plus investment plus government spending plus net exports plus net factor income. Okay. Consumption is the expenditure of all households. Investment is the expenditure of all firms. Okay. Government would be the expenditure of the entire government, national and local. Net exports is the difference between total exports minus total imports. And net factor income is the difference between income from abroad being remitted here minus income earned here sent abroad. For developing countries, net factor income is usually positive. They're receiving more net factor income from outside the country than sending abroad. For developed countries, net factor income tends to be negative. Okay. Their main sources of factor incomes being remitted from their countries towards other countries, usually the lower income countries. And when I say low income, high income, the measurement for that is the GNP. So that's on the expenditure side. That's the expenditure equation on the demand side. Okay. But expenditure means that the people and the establishment spending have income. So that's why there is an income equation on the demand side. Okay. We have total GNP or GNI, which is equal to wage plus profit plus rent plus interest plus indirect business taxes and depreciation. Okay. Depreciation is the expenditure on the maintenance of existing machinery, equipment, buildings, and the like. Okay. So all the maintenance expenditures, for example, cleaning up the old buildings in Ateneo de Manila, those are depreciation expense by maintaining these machinery, buildings, equipment, and the like. They are still useful for production purposes. Okay. Then you have wages, profit, rent, interest is the sum total of earnings of the different factors of production. Wage, therefore, is the payment for labor. Whether labor is being paid a wage usually refers to the payment to an individual largely for his or her physical capability, whereas salary is paid to an individual because the individual usually has what is called human capital, has education, skills, specialized skills, and the like, so that salaries tend to pay more than wages. Yeah. On the micro level, the salaries and wages are tracked separately and recorded separately. But on the macro level, on the GNP, they're all put together as wage. So payment to human beings for their labor or for their human capital, for their skills, all of them would be wage. Profit is the earnings of businesses. Okay. Rent is the payment for those who own space. Okay. And they're charging for the use of the space, rental income, and the like. Interest is the catch-all earnings for all the earnings on financial assets. Okay, so the earnings on bonds, on which are loans, okay, earnings on deposits, and the like. These are all placed as interest. Okay, payment to financial assets. Okay. Now, indirect business taxes are taxes like the value-added tax, tariffs, and the like, which are paid to government. Income taxes are computed really based upon the value of one's income, whether it be wage, profit, rent, interest. So the total of direct taxes are already included in wage, profit, rent, and interest. But for indirect business taxes, it's a separate category because the computation of that has nothing to do with the income being earned. Okay? So these are your two equations on the demand side, the gross national income equation. And they're always equal. And these two are always equal to the aggregate supply equation, which is the gross national product, which is equal to the sum total of the gross value added of the production sectors. The gross value added is the money value of the total output of a particular production sector. And there are 10 main production sectors. Okay. You have agriculture, fishery and forestry. You have mining and quarrying. There's manufacturing. You have construction. Then there's electricity, gas, and water. There's transport, storage, communication. Then you have trade, retail and wholesale trade. Finance, insurance, and real estate. Here, the real estate here is largely the management of real estate, such as the management of buildings, the real estate brokerage, the sale, the purchase and sale of units, in contrast to the actual construction that belongs to the construction sector. Then you have services, which includes education, healthcare, entertainment, okay, personal services, beauty parlors, barbershops, and the like. And there's the government. So the sum total of the gross value added of these 10 production sectors put together will always equal the expenditure equation on the demand side and the income equation on the demand side. Okay. So when you look at the website of the Philippine Statistics Authority, you will find their tables which show, say, the gross national product by expenditure shares, okay? Gross national product by income, and then gross national product by gross value added. Now, in the income equation, usually that's where you see the factor called statistical discrepancy. The statistical discrepancy is a number placed there just to ensure that all the three equations are equal. That just goes to show that estimation is never 100% accurate. Okay? And usually when the statistical discrepancy is less than 5% of the total, then the estimation of the gross national product is considered valid, reliable, and acceptable. Okay? Any questions so far? You can unmute yourself and ask me any questions as I proceed. Any questions so far? Okay, so let me now proceed, okay? The gross national income, or the gross national product, is the most widely used measure of standard of living of countries throughout the world. Data on this is available for most countries in the world. The World Bank has about just a minute. The World Bank has about they say they have data for 264 countries. That's quite a lot. But anyway, I know that there are about 195, 196 sovereign countries throughout the world. And therefore, the World Bank has data on all these countries on their gross national product, which is why you can make comparisons across countries. You can find out in the World Bank website. They've cut off income levels such that when a country's income level is above a certain level, it is considered an upper income country. Okay? Then of the middle income countries, there are two groups, the upper middle income and the lower middle income countries. Okay. the Duterte administration was hoping that by this year we would reach by 2020 we would reach the cutoff to become an upper middle income country. But the pandemic happened. So right now, the GNP per capita of the Philippines is just right below the cutoff to be an upper middle income country. Then, of course, you have the cutoff, such that below that, you would be considered a low income country. Now, what's the basis for the income? We'll get through that. So, if you're going to summarize those three equations of the gross national product or the gross national income, on the expenditure side, we have gross national product or gross national income being equal to consumption plus investment plus government spending plus net exports plus net factor income. On the income side, you have the gross national income or gross national product being equal to total wage plus rent plus interest plus profit. In economics, the Greek letter P, mispronounced in English as pi, is the usual representation for profit. Okay, plus indirect business taxes plus depreciation. And the GNP on the supply side is the sum total of the gross value added of the 10 production sectors. So sum total of the gross value added of the 10 production sectors I equals 1 to 10. Okay. Then from here, there are some concepts that you can develop based upon the equations themselves. Okay. And among the most widely used different concepts would be the gross domestic product. Okay, for a country like the Philippines, where a large portion of the country's gross national product involves the positive net factor income, it means that a large portion of the country's total GNI is due to incomes earned from outside the country. So if you'd like to have an idea of what the country's own economy, production sector is failing, then you get what's called the gross domestic product, which is gross national product minus the net factor income. Which is why for those concerned about the increase in domestic economic activity, they tend to focus more on the gross domestic product rather than the gross national product. Okay. Then, when you think of depreciation, depreciation involves the expenditure by firms on maintaining existing capital, existing machinery, buildings, equipment, land improvements, and the like. Okay. So if you have, say, net national product is gross national product minus depreciation. And this is an important concept because if the net national product is much smaller than the gross national product, it means a lot of businesses are actually spending more on maintaining their existing machinery, buildings, equipment, land improvements, and the like. In other words, they are not investing in new capital. They are not investing in new machinery, new buildings, new equipment, and the like, which suggests that their production capacity will not be increasing in the next couple of years. It suggests that many investors might be feeling uneasy about the future. So rather than setting up new factories, constructing new buildings and the like, they'll just keep on maintaining the existing capital they have, the existing machinery, buildings, equipment, and the like, which means a very large depreciation expense. And that's the importance of knowing what net national product is in comparison to the gross national product. Now, of course, it's gross national income, but when you're now talking about the incomes earned by human beings in the economy, okay, there is what's called the national income, which is equivalent to net national product minus indirect business taxes, which is then equal to wage plus rent plus interest plus profit. Okay? Wage, rent, interest, and profit reflect the factors of production that uh, the different economic sectors have. So for those who are being paid a wage, that would be people who are being paid for their labor. Okay? So their labor, either their physical capability or by their human capital, by their technical education, their capabilities, they're paid a salary or an honorarium for very, very specialized skills. The sum total of that is placed as wages. Okay? Even though wage data differentiates between wage, which is payment for individuals' physical capabilities, such as those in construction and in the sanitation services and the like, as opposed to salary being paid to people with higher levels of skills, like the professionals, educators, health workers, medical doctors, and the like. Okay. Now, rent is the payment for the use of the space of those who own space, those who own land, units in buildings, and the like. Okay, in order to produce goods and services and the like, you need space. So the rental is a payment for those who own the space. Okay? Interest is the earnings on financial assets. Okay, so in the financial sector, you do have a wide range of financial assets. Okay, each with its own interest earning, interest rate, and the like. Okay. We have interest rate on bonds, which are debts, interest rate on deposits, okay. Interest, the earnings on the sale of stocks, okay. It's put together as interest. Okay. And then pi profit would be the profits earned by businesses. Businesses that own machinery, buildings, capital, land improvements, and the like, and the earnings that businesses make, their profit that is put there. Okay, now the majority of people in any country earn a wage. Okay, now property income is the income that one earns if one owns property. Okay, so for one to have rental income, you need to own property. You need to own land or you need to own units in, say, condominium establishments and the like, and you're being paid rent on this land, this space that you own. Okay. In order to earn interest, you need to own financial assets. Okay. You need to have a bank account. You need to say you would have, say, purchase bonds or commercial papers. You would have shares of stock that pay dividends. Okay. So that reflects ownership of financial assets. And profit means that you own business. Okay, you own business. So that's the meaning of property income. In many societies, property income is usually from 40 to 60% of total national income. It's earned by a minority of the population. Only those that own property would earn this type of income. The majority are earning wage. Okay, so one of the measures of the degree of how equitable distribution of income is the share of property income in total national income. Okay, a society with a more equitable distribution would have the share of property income to be around 40% or so of the total national income. Okay, right. Any questions so far? Right. So now let's proceed. Now, when you want to make cross-country comparisons, here are the things to consider. The GNP for the year 2020 is estimated using the prices of goods and services in 2020. Then you also have GN, say from 2010, which use the prices of goods and services in 2010. The GNP data that uses the prices of that given year, okay, is called your nominal GNP. In the Philippine Statistics Authority website, they would call it the GNP at current prices. Current prices. Okay. So if you use data using what is known as nominal GNP or GNP at current prices, you will notice that the GNP from 2020 is always much higher than in 2010 or 2000 because price levels increase over time. Okay, that is an indicator of a growing economy. Price levels increase over time. The main difference between a problematic price increase, which is inflationary spiral, is simply the speed of the increase in prices or the inflation rate. For as long as the inflation rate is moderate, let's say up to 2.5%, for example, in Eurozone convergence criteria back in the year 2001, the targeted inflation rate the country ought to have in order to be considered eligible for membership in the Eurozone was about 2.3%. So for as long as the inflation rate is not very high, then it's not really problematic. One notices that the prices have increased a lot after several years. Okay, so therefore, uh, in order to measure how much product, total national product has really increased over time, you need to remove the effects of inflation. You need to remove the effect of the decrease in the purchasing power for the value of the currency, especially because GNP uses money in order to measure valuation. Okay. So you have what is called the real GNP, which is nominal GNP divided by the GNP deflator. Okay. The GNP deflator is a number that indicates the increase in price levels since a certain base year. Okay, so in Philippine Statistics Authority website, you'll find there GNP at constant prices of 2005. It means that 2005 is the base year. Okay, then they can measure. Therefore, the index of the base is 100. So they try to measure by how much price levels have increased from 2005 to say to 2019. And if the deflator for the index for 2019 is say 119. So the GNP 2019 in current prices of 2019 will be divided by 119 times 100. You therefore get you therefore get real GNP or GNP at constant prices of 2005. And this is the GNP that one uses for long-term comparison. So if you'd like to make a comparison of the GNP of the Philippines from 1990 to 2020, you have to look at the real GNP or what is classified as GNP at constant prices of a certain base year. Okay. Now you notice that the base year changes. Okay. It could be 2005, before that it would be 1995. You just rebase it. Okay. You just keep, so if you're going to rebase it with 2005 as the base, you just have to find out what's the index of 2005 as opposed to 1995, and you just recompute. And then you can therefore have GNP from 1990 to 2020 at 2005 prices. Okay. And the World Bank database, they have GNI and GNP data at what is called LCU, or the local currency unit. Okay. So there is the Philippine data using Philippine pesos. There's the Japanese data using Japanese yen, the data from China using the yen renminbi. There's the data for Australia in Australian dollars, in Canada in Canadian dollars, okay? In order to make comparisons across countries, okay? The GNP data in local currency unit, or LCU, of every country is converted to the US dollar, okay? And when converted to its US dollar value, then you now have GNP data for all countries. So you can now make comparisons across countries. But if the conversion involves the use of what is called the official exchange rate, then that is what's called the GNP at US dollar nominal. It uses the official exchange rate. And the thing about the official exchange rate is that the official exchange rate is actually very changeable. Okay, it can have several. For example, right now the exchange rate of the Philippine peso to the US dollar is 48.50. At this before the pandemic, it was 50 pesos 15. Okay, which is why in the World Bank data set, you do have a choice of using what is called the Atlas method, where the Atlas method converts the GNP into the US dollar value using the average of the last 5 years. Okay? That's to remove the variability in the exchange rate. A stable exchange rate would mean that the exchange rate does not change too much, okay, but it still does. Okay, so for example, the appreciation of the peso from 50 pesos 15 to 48 pesos 50 centavos is quite substantial. It's not much. It's only about 2% or so. Okay. Again, if you look at the convergence criteria for the Eurozone, that is the norm. Okay. They have a band such that the exchange rate has not changed too much in the past 2 to 3 years before membership in the Eurozone. Okay, and then if you now have GNP data in US dollar values using the Atlas method, then you can now make comparisons across countries, but countries vary. Okay? Some countries are huge. You have huge populations like China and India. China with a population of 1.3 billion, India is about 1.25 billion. In a few years. There will be more. India will have a bigger population than China. In the Philippines, it's a population of 110 million. Malaysia has a population of about 28 million. Singapore has a population of 7 million. You have wide differences among countries, which is why, in order to remove the effects of the size of the population, you then get GNP per capita, which is the GNP, usually expressed in the dollar value, divided the population of the country. So you therefore have your GNP per capita data. And it is the GNP per capita data that the World Bank can establish income classes. Okay? So countries with GNP per capita above a certain level would be classified as high income countries. Then there are those from this income level to this income level, which are upper middle income countries. Then you have another, the lower middle income countries. Then you have finally here, the low income countries. Just a minute, somebody's making a phone. Okay, telemarketers. Okay, so where was I? Okay, so it is the GNP per capita data, therefore, which is very, very important, determining a country's classification as a low income, lower middle income, upper middle income, high income country. As I mentioned to you, we could have become an upper middle income country if there was no recession last year, but there was. So now we are already suddenly a bit far away from the cutoff to become an upper middle income country. Being an upper middle income country does have certain consequences. Of course, there's the prestige of being an upper middle income country. It also means that we no longer have access to what are called concessional loans in the World Bank and multilateral agencies, meaning to say we no longer can borrow at the preferred interest rate and the like, which is actually not much of a problem for as long as the country has what is called a high investment grade rating, this time determined by the private commercial banks. And we've had a increasing commercial rating since the time of Gloria Macapagal Arroyo, which meant that when the investment grade rating is improving, the interest rate on loans being provided to the Philippines tends to be decreasing. Okay? But anyway, those are just some of the implications and why the gross national product data is considered important. Any questions so far? Comments or clarifications? Okay. Any questions? Okay, none? All right. So, none yet, none. Okay. Now, there are certain limitations, though, in using the GNP per capita to establish the standard of living in countries. China, for example, has a higher GNP per capita than the Philippines, the same with Indonesia, Malaysia, Thailand. They have higher GNP per capita than we do. They're already upper middle income countries since a few years ago. Um, so it would seem like the standard of living of the average household there would be higher compared to ours. But then one cannot be too sure about that. That's because the GNP data does not give any idea of the income distribution. So you would have countries like Mexico and Brazil, whose GNP per capita is far higher than even those of China and Thailand. but the standard of living of the average household there might actually still be quite low. And that's because historically, Mexico, Brazil, Latin American countries have had a more inequitable distribution of income. Okay. So to get an idea of the distribution of income, one has to use another set of data, which I discussed in module 2 when we're talking about the family income and expenditure survey, where you have there the Gini coefficient measure the distribution of income. So the GNP per capita data by itself cannot give an idea of the income distribution of a country. Also, non-monetized transactions are not included in GNP. Okay? Non-monetized transactions like cooking your own meals at home or doing your own laundry, your own clean up, and the like. Okay? There are very, very many reasons being offered why the country went into a very deep recession last year. Okay. Of course, a lot of economic activity was slowed down. A lot of businesses, a lot of activities had to stop for several months and are starting only very, very slowly, like in construction and like. But also, there is the case that, as they said, more and more households with time on their hands did their own cooking and baking and that sort of thing. So as you can see, when one cooks your own meals at home, it's a non-monetized transaction. Okay. And that's why it can happen that when people start to not do much cooking at home anymore, but start buying food outside, then that would cause the GNP to go up. However, that may not necessarily indicate an actual increase in the production level of a country. It simply meant that what used to be non-monetized became monetized. Okay? So that the more monetized transactions there are in a certain country, the higher the GNP becomes. But that does not necessarily reflect on production. And again, GNP accounting is undertaken by government. So automatically illegal activities are not included. Okay? And when you make comparisons across countries, you do come across the case that some activities are legal in other countries, illegal elsewhere. Okay? Commercial sex work and the production and sale of certain types of narcotics, like cocaine and the like, are legal in most European countries, okay, but not here in the Philippines. So if ever commercial sex work and you have sales of cocaine happening here, those activities are not included in the country's GNP because they're illegal here, but they're legal in the other countries. Okay. So effectively, the lesser the number of illegal activities, then the greater the GNP is able to capture the value of actual production. But again, it does not necessarily reflect difference in the standard of living. It's simply the case of lesser illegal acts in another country. Okay. For developing countries, there are additional limitations to consider. Okay. It is said that there are real differences among countries. Okay. Singapore is a high-income country, but its GNP per capita is not high compared to many countries in Europe. Okay. They say that to a degree that's because there's a higher expenditure in Europe and North America on the fact that being in a temperate zone country in a given year, they have a much wider temperature difference from winter to summer. That's why people have to have at least two sets of clothing, and they have to spend a lot on heating and the like during the cold months. Society also has to spend a lot on snowmobiles, snow shoveling, and the like. Okay, all of these require substantial expenditure, and that could push up the expenditures in the European and North American countries, but they may not necessarily reflect a genuinely higher material standard of living. It simply reflects differences, real differences. In this case, we're talking here about climate differences. Okay. Then there's the informal sector. The informal sector is a characteristic of developing countries. This is the sector that is not integrated with the rest of the economy. When you're talking here of the GNP, data on GNP, household expenditures, they're usually obtained from business firms, okay? From especially business firms that sell consumer goods, like from retail and wholesale uh, establishment, like sales of SM, Robinsons, and the like. Investment expenditure, again, the information comes from business firms, business establishments. The same with net exports and net factor income data, they're obtained from the banks. Okay. And the same way, wages, rent, interest, profit, indirect business taxes, depreciation, the data here come from business firms, both those engaged in finance and non-financial activities. Okay, that's because, by law, business firms have to be registered with the government. Okay? And a business firm has to have a well-defined office. Okay? That's why right now, when people are working from home, it's really a major change from the standard practice, that there's a difference between one's residential area and one's work area. Okay, the business establishment is a work area, so there's a well-defined space, and they're registered with government, and they have the staff there, and they're sending information to government with regards to their expenditures, the wages being paid, the like. So through these, government is able to get data and information on the GNP. But when you're talking here about the informal sector, you're talking here about what we all know among ourselves, the squatter settlements, the informal settlements here. These low-income establishments, many of them are not very, very far away from where we are. You have quite a lot of them around Ateneo de Manila. Okay, and here, these are supposed to be residential areas, but a lot of those residences are actually places where a lot of family businesses are going on. Yeah, family businesses, they would have carinderia, they would have, tailoring shop, and dressmaking establishments. They'll be making furniture. They'll be they'll have beauty parlors and the like, and they're located right there where they live, and these are not registered with government. So the total expenditures they make, any payment of wages, salaries, and the like, do not get included with the GNP. Okay, and they're not integrated with the rest of the economy in terms of the fact that with the rest of the economy, what is called the modern sector, there's a difference between the residential area and the work area. That's why data can easily be obtained from the workplace. Okay. A characteristic of developing countries is that they all have large informal sectors. Therefore, the GNP data actually, it said, may actually um, not reflect the total output of the economy, because the output and incomes being paid in the informal sector cannot be measured. Data cannot be obtained very easily. Then you have the case of the valuation of non-traded goods. Okay, non-traded goods are services and infrastructure, such as the value, of the price of train services, of bus services, and the like. They are non-traded because it doesn't make sense to trade. You don't fly all the way to New York or to London just for a haircut because those are services. The transport expense already is far higher than the actual service itself. That's why you don't trade it. Just as infrastructure is fixed, you cannot live in Metro Manila and enjoy the Hong Kong subway system. It stays in Hong Kong, just as we are trapped using our MRTs and LRTs. Okay. Now, in developed countries, the money value of traded and non-traded goods are quite similar to each other. But in developing countries, traded goods have a value close to their international price levels, but non-traded goods have a far lower value, which is why when you sum up the valuation of traded and non-traded goods, it said that for less developed countries, the resulting GNP in local currency unit uh, understates the level of economic activity. And again, you have the case of the use of official exchange rate. The official exchange rate is supposed to reflect the demand and supply for foreign currency. And here in the Philippines, since 1993, when the foreign exchange market was liberalized under President Ramos, the official exchange rate has been determined in the foreign exchange market, which in the Philippines is known as the Philippine Dealing System. And the exchange rate is determined there through the supply and demand of foreign currency. But there have been times in the histories of many countries where they tended to overvalue or undervalue their exchange rate. An overvaluation would be, say, here in the Philippines, rather than an exchange rate of 50 pesos to $1 as determined by the foreign exchange market, the official exchange rate, if overvalued, would be 40 pesos is to $1. And notice the effect of that. It would mean that imported goods are cheaper. Okay? And historically, in the case of the Philippines, it said that before 1992, we tended to overvalue our exchange rate in order to keep imported petroleum products affordable because we were heavily dependent on imported petroleum at the time, not just for transport, but also for overall energy needs. But since then, we no longer rely too much on imported petroleum, especially for our electric power requirements. Okay. Now, countries like China, Japan have been said to be undervaluing their exchange rate. So if the Philippines were to undervalue, our exchange rate would be 60 pesos to $1. And the effect of this is that it makes imported goods more expensive, but it also makes our goods cheaper for exports. The export prices of our goods become lower. So it is said that countries like China and Japan that undervalued their currency did so to promote their export sectors. Okay? Japan was supposed to have been undervaluing their exchange rate until around 1987, when Japan was forced to actually let the foreign exchange market determine its exchange rate under what is known as the Plaza Accord, named after the Plaza Hotel in New York, where the agreement was reached. Okay, so when the official exchange rate is overvalued, it's said that the dollar value overestimates the GNP of a country. When the GNP, when the official exchange rate is undervalued, it's said to be underestimating. So that's why there are some measures of the standard of living that are used to supplement GNP data. Okay? To really find out, it is said that what the standard of living of a country is, some would prefer to use consumption per capita. Okay, because consumption is the actual expenditure of households. So rather than GNP per capita, where GNP includes investment, government spending, net exports, then they look at consumption per capita because that exactly was what was purchased by households, okay, in the given year. Then you also have the concept called social wage. Okay, from your national income accounts, you have your property income, you have what's called your social wage, which is the sum total of wages plus transfer payments. Transfer payments are payments given by firms to their employees that have nothing to do with their productivity. A person's salary or wage is supposed to reflect their productivity. That's why if they're seen as having higher levels of productivity, they do get promotions, they get higher salaries and the like. So that's why the higher you are in the executive positioning, then you're paid more because as a higher ranking executive, you're expected to undertake more decisions and valuable work, so you're paid more. But the transfer payment is given to employees regardless of their position. So, for example, firms might provide for health insurance. Okay? And in Ateneo de Manila, we all get what is called a rice allowance. Okay, the rice allowance is a cash equivalent to 5 kilos of bigas every 15 days. And this cash grant, the rice allowance, is supposed to ensure that each employee can purchase 5 kilos of bigas every 15 days. Okay, and the and then you have what's called government transfer payments. Okay, such as pensions for the retirees. Okay, um, and conditional cash transfers, okay, for the low income classes in order to have their children go to school regularly and undertake regular vaccinations and immunizations. Okay, these are government transfer payments. Plus, government expenditure on consumption items. We need to say government spending on items which are actually available in the market, such as education. Okay, when it comes to education, you have private schools and one has to pay uh, their tuition fees. But when you have government funded schools, these are free or with very, very low tuition. Okay. The idea with the social wage is that wage involves the earnings of laborers, but when you add transfer payments, government transfer payments, they add on to what they're earning. Okay, and with the government expenditure and consumption items, it means that items such as education, if being provided for free, would mean that what the wage earning households would have spent on education, they can now spend on other things. And therefore, you'd have an improvement in their purchasing power and in their having disposable income. But of course, government transfer payments and government expenditure and consumption items are paid for by taxes, so you deduct tax. When the social wage is positive, it means that the wage earning households could very well be enjoying more by way of government expenditure than what they're paying for in taxes. So there would be a redistribution of income towards the wage earners, who are the majority in the population. And the social wage is negative. It means that they would be paying more by way of taxes than they're actually able to benefit from government expenditure and transfer payments and and consumption items. Okay, so this again is a method of measuring the standard of living of households. There's another one discussed in the textbook, which I would encourage you to read on and master, and that's what's called the Human Development Index. Okay? Where the Human Development Index is the number that puts together the GNP per capita, the infant mortality rate, and the literacy rate. Literacy rate is used as a measure of the level of education in the country and therefore a possible measure of the human capital or the education, average education of the population. The idea you see is that when the population is a higher human capital, then they can be expected to attain higher productivity and therefore generate more income as compared to another society with the same population but lower human capital. Okay, the infant mortality rate is a measure of the quality of health service. One of the defining characteristics of developed countries would be if you check the of an excellent quality public health care system. Okay, so so that's why Human Development Index is also used to supplement GNP data in order to measure or represent um, standard of living. Okay, now there's another way of measuring a country's GNP in US dollars, apart from using what's called the Atlas method. And that is using what is called the purchasing power parity adjustment. The purchasing power parity adjustment is based upon the theory that an exchange rate is supposed to equalize the purchasing power of currencies. Okay? So what this means is, let's say, with a 50 peso to 1 US dollar exchange rate, it would suggest that what 1 US dollar can purchase in the USA, 50 pesos can purchase in the Philippines. Okay, that's supposed to be the meaning behind the purchasing power parity theory, which assumes that the exchange rate has always been determined by the supply and demand for foreign exchange. But there have been historical circumstances such that the level of the exchange rate may have deviated from what would have been the level determined by supply and demand for it. And that's why there is a purchasing power parity adjusted GNP. And that is usually the one used by economists to make comparisons across countries. They look at what is known as the purchasing power parity adjusted US dollar GNP figures. Okay. Now, the purchasing power parity adjustment is based on the estimation done by the World Bank a few years ago, where they decided on, they look for a commodity that is common to all countries, to all societies, and that's usually carbohydrates. Okay, so what they did was that the World Health Organization has a certain minimum daily carbohydrate requirement for an individual to satisfy minimum daily nutritional requirements. So there's that minimum daily carbohydrate requirement in kilocalories. Okay. This carbohydrate requirement in kilocalories is converted into the most common source of carbohydrates in a country. So here in the Philippines, they use the bigas of NFA. The United States, they use white bread. In France, they use the baguette. In the United Kingdom, they use a certain type of potato. Okay, So the carbohydrate requirement in kilocalories is converted to certain quantities of these, and they get their prices. Okay, and they get the ratio of these prices to the US dollar value. Okay, so what happens is that the purchasing power parity adjusted figures, okay, for the United States, of course, it doesn't change because the United States dollar is the what is called the numeraire or the reference value. And what happens is the US dollar adjusted values, purchasing power parity adjusted values, US dollar values of GNP in many European countries and in Japan, they all go down, which really reflects the higher prices of goods and services there. Whereas for many developing countries, including the Philippines, the purchasing power parity adjusted US dollar value will tend to go up to reflect the very low prices of non-traded goods in the country. And when a few years ago, there were people talking about China already having an economy that is much larger than the US, they use the purchasing power parity adjusted value of the GNP of China. Okay. Now, finally, entitlements do not really are not really representation, are not really a form of the data. It's more of a concept. Okay? And this is the concept that was proposed by the Nobel Prize uh, in economics Professor Amartya Sen, okay, where he suggested that in addition to using GNP per capita and in addition to Human Development Index, to understand the process of economic development, it might be worthwhile to consider that economic development is the process of increasing entitlements over time, where he defined entitlements as the goods and services available to the average household in a country. When you say available, it means that the goods and services either are affordable or they're being provided by government. For example, the United States has the emergency service system called 911. Europe has its, I think it's 2222. Okay. So in these countries, whether you come from a high or low income country, in case of emergency, there's the emergency assistance service available as long as you have access to a telephone and you can call 911 or 222. In many European countries, you can avail emergency assistance in case of fire, in case of accident, in case of possible burglary or forced entry into your house and the like. Such a service is not available here in the Philippines, even for the high income families. So it's really not part of our entitlements. Okay. So it is said that development would involve increasing entitlements in a country. Okay. He cited as an example back in the 1970s, China and India. In the 1970s, China and India were still in a very comparable level of economic development, and they have the largest populations in the world. And Sen noted that China had a much lower rate of malnutrition compared to India. So that is said to be an entitlement of China, a low rate of malnutrition, a food distribution system that's able to guarantee a very low rate of malnutrition. It does not involve food abundance. Back in the 1970s, no, there were very, very few people in China who were overweight, but none, very few were malnourished. So their food distribution system, which is not always market-based, was able to at least guarantee minimum nutritional requirements for the majority of the population. So it had a low rate of malnutrition compared to India. India with a higher rate of malnutrition than China. So the low rate of malnutrition, therefore, is one of the entitlements of China. However, Sen noted that both China and India are affected by natural calamities, by typhoons, which are called monsoons in India, by earthquakes and the like. Okay? And Sen noted that India had a much lower rate of fatalities than China whenever there were natural calamities, which he attributed to to the fact that India had a free press. And by having a free press, it's able to spread news very, very quickly with regards to the location of possible survivors, and therefore they can easily be assisted, which is not present in China. In fact, it's one of the things being, to this day, being blamed on China, that because of the absence of a free press, no one is quite sure really how this coronavirus epidemic began there. Okay? So it is said that India and China were really developing countries because of different sets of entitlements. So to become developed, okay, they would have increasing entitlements over time. Okay, lower rates of malnutrition and lower rates of fatalities brought about by an efficient food distribution system and the free press that allows for easy assistance to those who may have survived natural calamities. Okay, any questions or comments right now? I end here. This is the main direct lecture with regards to gross national product accounting, gross national income accounting. When I say proposed alternatives, these are just some. This is especially because of the limitations of using GNP and GNI in order to measure the standard of living. That's why they are not meant to replace it, but to add on to it, just to point out that GNI data, GNP data, has a wide range of uses, but also has some limitations. So to get a better, broader understanding of the issue of the standard of living and how it changes over time, you look at additional data sources and concepts, conceptual approaches like that of entitlements. Okay. So any questions as of now? Okay. Mr. Innocentes, you're the one who requested for this. I was wondering if I fulfilled your request.
Yes, sir. Thank you.
All right. Any questions or comments you want? Remember, when you're talking here about graphs and the like, siguro kayo mapasensya. Ako hindi naman masyado, matanda na ako. But you can actually get to the World Bank website, okay, and choose the different data there. And, you know, they can produce the, for you, they can produce the graphs for you. Like this. Ayan, it can be presented in a table, in a chart, in a map. Okay, it's up to you. It's up to you to actually program it. Okay? It was able to get the GNI using the Atlas method and the GNI per capita using the Atlas method. Kasi for a country like the Philippines, ayan, may data for 1960 to 2020 so that they can present the data in graph form and the like. Okay, so this will be the one that's helpful if you'd like to come out with graphs and charts of GNP and other data that which you can easily find at the World Bank website, World Development Indicators website. I'll be posting the recording of this lecture in our Canvas website, both for Euro 24 and ECHO 121. In your section, the other section did not ask for this. And okay, so just download the recording within 2 weeks before Zoom deletes it. So if there are no questions as of the moment, so I suppose I'll say good evening for now. Okay, bye-bye.
Thank you, sir.
My pleasure. It's
Thank
Matanggihan.
you, sir.
Thank
My
you,
pleasure.
sir.
Yeah, it's my
Thank you,
pleasure.
sir.
Okay, good night. Bye.